Okay guys, so last week things got a little spicy. Check the link in the description for that video. It's time to move on, I think. This week I considered talking about positive investing, specifically his magic metric for dividend hunting. I had something to say about that. I also wanted to cover Bruce Wang, great name by the way. I had a lot to say about his portfolio, my criticism being very analogous to the spicy video. Not quite as bad though. And damn dude, that watch. And you're telling me it's got Oyster Flex rubber? Okay, so PPCIAN is the subject of this video. I'm going to break down his video titled My Dividend Stock Picks Are Up 44%. Let's just jump right in. Okay, here you see a list of PPCIAN's videos released over the last 2 years with his corresponding trade dates, price, and some other stats that we'll get into. We don't see how many shares he purchased or how much of his portfolio these purchases represent. We also don't really get a sense of his cost basis for these positions. We're really only getting a snapshot of reality here, though I don't doubt his cost basis is much lower than some of the entry points reflected in his video. Certainly the opposite is true for at least some of these positions. I, on the other hand, will be showing my positions at the end of this video to see how they compare with Ian's entry point, as I can't critique him on transparency if I am not being honest with you guys. Okay, with that preface, let's just jump right in. This is Fast Graphs, a research tool, and here we're looking at Apple, ticker symbol AAPL. I'm covering this in alphabetical order. Ian says his yield on cost is low, but the cap appreciation, which he cares less about, has been great. He's actually up 111%. Show that there. He says that the stock is currently not a bad value, but he won't be buying it at a PE of 24. It's actually a PE of nearly 26 as of this recording. But he would buy it in the lower 20s, maybe, he says. You're going to see this orange horizontal line on every stock that I show you. This reflects his average cost, which he says is $151.09. This little green dot is the date that he says that he purchased the shares at that price. So he got a PE at the time of 12.7. So that's the price divided by the earnings for that period, which was $11.91. We'll get into it later, whether or not it was a good or bad thing to purchase at this exact moment, whether that's lucky or not lucky, which Ian addresses in his video. I want to point out the current dividend yield of Apple is less than 1%, which is something many dividend investors would scoff at. Ian, of course, got in much lower than the current price, so his yield is close to 2%. We can just call it a 2% yield, and it's reasonable to believe that that yield on cost will continue to grow pretty quickly. Here we have a 7-year dividend growth rate compounding at 34%. Now you can disregard a lot of that because in 2013 we have a huge dividend increase, but suffice it to say, expecting low double-digit earnings growth, considering the current payout ratio and considering the earnings growth of the company, that 2% yield on cost should grow very quickly. I think Ian is basically right here. The market has placed a PE ratio of about 15.5 during this time period. Sometimes it's a little undervalued and other times it's a little overvalued, but now it's trading at a 26. He said he wouldn't buy it at a 24 PE, maybe less in the lower 20s. So if that's the case, why might buying at a PE of 20 to 21 be good when the prices had been much lower previously? Again, 15.5. It's not like earnings are accelerating. They seem to be slowing down, in fact. Here, let me move the chart to better illustrate that. Stock multiples are really about perception. It's how much we feel like we're willing to pay for earnings. People are beginning to perceive, I believe, Apple not just as a mature telecommunications hardware company with excellent balance sheets, but now they're seeing it as a sticky, reoccurring revenue service company with about 1 billion users worldwide, waiting to further be monetized. Stocks like this might deserve a multiple over 20. So Apple could be in a period of being re-rated. Re-rated like Clorox. Clorox has much less earnings growth over their history and even over the short term. However, it consistently gets a multiple much higher than Apple has over the last several years. Now, back to the Apple chart, here we're zoomed out. You can see that perhaps Apple is near fair value If this is the current rating for the foreseeable future, then analysts project annualized returns of near 10%. Whether that's realistic or not remains to be seen, but when you cut time off the graph, as I illustrated earlier, with this level of growth, Apple looks very expensive. If it reverts back to the mean, obviously there is significant downside risk here, but it just remains to be seen how the market's going to evaluate this company going into the future. Is this a stock that deserves the 15 to 16 PE? Or is it the stock that deserves the 25, 26 multiple? That all remains to be seen. So next up, let's do AbbVie. Here's AbbVie, ticker symbol ABBV. Reasonable value. Will be buying more, Ian says. He puts out that the risk some people are worried about is patent protection expiring for the prescription drug Humira. He calls this worry overblown. I think he's right, but you also have to factor in some regulatory risk as well. A single-payer system has some percentage chance above zero of being implemented. How might that affect pricing power for a company like AbbVie? How might that affect patent protection? What happens if or when AbbVie isn't allowed to buy smaller companies to support future earnings growth? I like the stock a lot at a PE in the 7s. 8's not bad. You see here, Ian got this stock at $69.02, which represented a PE of 8.2 at the time. I liked the stock a lot at a PE in the 7s. Yield on cost, you get about 7%, and it's growing super fast. So just look at the last 5 years. You can ignore 2013 where they increased the dividend by 300%, but just going since 2014, you have double digits, you're double or near double digits. 2015 it went up 20%. In 2018 it went up 50%. Doing math in my head real quick, that looks just shy of 10% dividend growth in 2019. Payout ratios look good, and large dividend increases in the future should remain intact, but not without some level of risk. I'm not personally looking to add more, but I'll certainly reinvest the dividends. There appears to be a lot of value here, and reversion to the mean can be a powerful force. There you see a 58% total return expected by analysts if we get a reversion to the mean back to this normalized PE of just under 14. Analysts have been very accurate at predicting the earnings for this company. They were most off in 2018, where the company beat earnings by over 17%. So with some degree of accuracy, this light green shaded area is analyst projections. This would be the normalized PE based off those projections. And again, if AbbVie reverted to the mean, you've got significant stock appreciation there. And you're buying a starting dividend yield at 5.54% that, like I said, has room to grow very quickly. So this is an attractive stock, but I just think there is regulatory risk that may not be factored in completely by Ian. And the problem is, I don't think we're really going to get much daylight in the way of those headwinds till after the election in November. But of course, by then, it might be too late to get a good entry point. That's just the nature of the market. But like I said, we're currently trading at a 9.5 PE. If we got back into the 8s, closer to the 7s, I think I would be buying this again. Whereas Ian said he's still buying, I believe. All right, next up is Campbell's Soup Company, a ticker symbol CBP. Ian doesn't say much about this one, I think because there's not much to say about this one, but I want you to take a look at this. This company during this 20-year period grew earnings at 2.16% during this entire time period. Again, this green shaded area is the earnings. This blue line being the normalized PE for this time period, just under 17. 2% earnings growth, not very impressive. And when we take time off the chart, in this period, the growth rate is 1%, 1.09% to be exact. It's actually less than half of the historical average for this company. Ian just happened to snipe this stock right at the bottom. Boom, right here, got it, 11.8 PE. Good on him. The normal PE ratio, again, for this time period is 16.22. That's this blue line. You can see how the stock does a good job reverting to the mean. It gets a little cheap relative to this blue line. It goes up. It gets expensive, comes back down, cheap where Ian got it, and it goes back up. So if you're into trading, this is a great stock to trade. It's consistent, but it's not a good company. Again, the normal PE ratio for this time period is 16.22, implying it was undervalued by about 38%. However, Ian got a total return of nearly 50% when you're factoring dividends, of course. The problem he has now, the stock is certainly overvalued. Earnings have been flat or falling, depending on your starting point. Long-term debt is definitely high. The dividend yield isn't anything to write home about and doesn't appear to be really growing either. I'm not a trader, but whenever this happens, it's a trade. The stock certainly isn't worth buying here. Holding it is okay, but had I been Ian here, well, one, I don't think I would have bought this thing, but had I benefited from reversion to the mean as well as he did, I think I'd take this as a winner and sell it and put that money to work somewhere else. So let's move on to next stock. Here we have General Mills, ticker symbol GIS. He does actually say he's excited about this one. The company itself is very much like Campbell Soup, both being in the same industry, both growing earnings anemically. General Mills is growing faster. Here you have a 6% earnings growth rate for this entire history. When we cut some time off the graph, earnings growth slows down. We're below 4%, cut more time off the graph, and now we're below 3%. So earnings growth never great, and it's certainly slowing down. However, compared to Campbell Soup, the earnings growth is certainly better, and it does have better balance sheet. It's cheaper not only on a PE basis, 16.3, but relative to itself, we still have room to run here if we're reverting to the mean, implying a near-term total return of 15%. You're starting with a dividend yield of 3.61 if you purchase today, much better than Campbell Soup, and that dividend has a mixed history of growing. However, it has been frozen since 2018. Analysts do project that it will return next year, and there's certainly reason to believe that this stock will grow its dividend faster than Campbell's Soup, considering that both earnings growth and the long-term debt is superior for this company. Again, this shaded green area is the forward projections by analysts. I think they're good. This is a consistent company that's easy for analysts to predict. Here you see their scorecard, and they've done a pretty good job. Every prediction has been under 10% difference than their actual one-year forward. So, for instance, 2019, the one-year forward predictions were $3.19. The actual operating earnings came out to $3.22, which represented a beat of 1%. So they're very accurate. They've been very accurate predicting this company. I think it's fair to say that the future appreciation in the stock price is more likely in this company than in Campbell Soup. I certainly like it more. However, I can't say that I'd be a buyer here. I was. For me, I'm just happy to hold. And I don't know what Ian is planning on doing, but his yield on cost is 4.4%. So that's not too bad. And I think he's still got upside. All right, let's move to the next stock. Here we have Leggett & Platt, ticker symbol LEG or LEG. This is another company I don't have an allocation in. Ian says he loves these guys. I would too, dude, if I had a 38% return over a 7-month period. That, of course, factoring in dividends. He says he's not buying, however, at these levels. I don't blame him. There is certainly a cyclicality to this company's growth. You can see it in the operating earnings, but you can really see it in the stock price. If we change the metrics here from operating earnings to operating cash flow, you can certainly see the cyclicality better back to operating earnings. So we see a growth rate during this time period of 3.33%. I'm going to cut some time off. Earnings growth during this period is actually better. I'm going to cut a little more time off. And again, we're getting 8.6%. For this time period, analysts projecting 7% for the year 2020, 9% for 2021. Let's see how well they've done in the past. They're off a couple times, but not too bad, actually. If the company doesn't perform up to expectations for 2020, where analysts are predicting 7% earnings growth, there's a pretty good chance that this stock price will fall again below the blue line and may afford us a better entry point. I think if the analysts are wrong, if the company underperforms, then we might get a better entry point for this in future. However, a business like this really don't attract me. If I was Ian, I'd be a holder too and not a buyer. I wouldn't buy again unless this thing touched earnings again. If we could get it down to a PE 15, close to where Ian bought it. Again, the dividend yield right now is 3.12%. While it looks like Ian's yield on cost is over 4%, the performance has been okay. Its compounding growth rate the last 5 years has been 5%. For the 19-year period, the compounding growth rate has been closer to 8%. You can see there's periods where they continued to pay the dividend when the dividend payout ratio was above 100%, but looks like the ratio is in a lot healthier position now. I don't know, something to continue watching, but not really a stock that interests me all that much. All right, let's move on. So this is 3M Company, ticker symbol MMM. Okay, so this is the first entry point that hasn't been super super spectacular, right? Here we see Ian buys in here, coming off of a nice drop in the share price. The share price had just dropped nearly 22%. Ian gets in. The stock moves up and down for a period of several months and then dropped another 23%. And it's currently bouncing around again. I'd like to point out, because I was in a similar position, Ian in this moment was looking at the stock coming off this 22% correction. Much to do, I believe, about trade fears at the time. The market often overreacts to headlines like these. If we cut some time off, we have a company coming off double-digit earnings growth, 12%, and a dividend is compounding at double digits. So Ian thought it was good to limp in here. I too did the same. I also like that he brings up lowering his cost basis as the stock continued to drop. He was probably buying throughout this period, lowering his cost basis, lowering his average starting yield. If it was good for him here above 190, then why not now, right? You should always take the discount that the market is offering you, as long as the underlying fundamentals aren't changing. Again, during this time period, you've got the earnings increasing, actually accelerating, right, from 2015, and the stock price is falling. These are usually good times to buy. Now, my cost basis is near the current share price, which is, I believe, at or near fair value. Analysts have been very good at predicting the earnings for this stock. They're predicting 6% for 2020 and 8% for 2021. Now, I'm not sure what Ian intends to do going forward. To me, the stock is at or near fair value. I do believe there are both head and tailwinds that are difficult to calculate, and I do like this company. So for now, I'll be reinvesting dividends, but I don't believe I'm putting any new money in here unless we see another decline in the share price. All right, let's move on to Altria here, ticker symbol MO. Ian says he still sees value here, that he may buy more shares. One thing I just want to point out, his green dot is well off of the black line you see here. So it's like, how did Ian get shares that low in January 28th of 2019? Well, this black line represents the average monthly share price. So for the month of December and January, your monthly price of $49, but it certainly got low enough for Ian to score this $44.72 tranche, as he calls it, which has worked out pretty well for him. I've said a lot about Altria in previous videos. You can check those out. I'll put a link below. It's a stock I follow closely. I agree with him here. I've been trying to increase my exposure with the stock. He does say that he might be too heavy exposed in sin stocks, so I don't know how aggressively he's purchasing shares of Altria, but there's value to be had here, and analysts have done a very good job at predicting earnings growth for this stock in the past. I mean, they've done phenomenal, with the exception of 2018. They were off by 10%. The company beat by 10%. So I'm pretty optimistic about this stock, but my rate of purchasing shares really depends on what the stock does from here on out. If it goes up, I'm going to slow down. If it goes down, I'll try to buy more aggressively. All right, let's move on. So here we got Procter & Gamble, ticker symbol PG. Damn you, Ian. 77% total return. This is crazy. In just a few months. Congrats on that, Ian. This is a decent company too. Ian's 4.1% yield on cost should grow at about 5%, I would say. Though you can see the 20-year history here is a compounding growth rate of 8.5%. I would say that's slowing down for a couple reasons. The payout ratio is getting higher, but also the earnings growth of this company is slowing down. So two things to factor in there. The balance sheet looks really good though. I think Ian did a great job. Not a company that I like to follow, but certainly popular in dividend investing community. Now, analysts are projecting a double-digit earnings growth for the year 2020, and their scorecard has been fairly accurate. Some misses here, but the last 3 years have been pretty accurate. Suffice it to say, not earnings growth that would compel me to buy this company at a PE of 26.24, which is where it's currently trading at. Again, good on Ian at getting it below this blue line. I wouldn't consider the stock until it went below this blue line again. I'm not above buying companies that are growing fast above the blue line. Sometimes that's all you can do. But again, the growth rate on this company has not been good. It's been slowing down. Analysts are predicting it to speed up again, but I believe it's been over-reflected in the price of the stock. The starting yield, if you bought it now, is 2.39%. Again, that's way too low considering the expected growth rate of the company and the rate at which they're increasing the dividends. It's not good enough for me. For Ian, I would suggest this is a strong hold. I don't know what his plans are. I wouldn't sell, but I'd certainly use these dividends to reinvest elsewhere. I don't think I would use them to reinvest with this company until the stock price got close to that blue line. All right, let's move on. All right, PPL Corp, ticker symbol PPL. This is a utility company. This is, I think he's got another utility company we're going to cover in a minute. Just a fabulous buy by Ian here. You can see this is another company that's not really growing earnings. I'm going to cut some time off the graph here. You can see during this 19-year period, earnings less than 2% growth rate. I'll cut more time off, cut the Great Recession off. Here you still see 2% earnings growth. Cut this little chunk off there and see what happens. Going back, we've got actually nearly a negative 1% earnings growth rate. However, Ian was able to purchase this underneath the blue line, and he got one hell of a turn. Ian killed it. He got a 27% return in just a few months. Good on him. He grabbed this stock with a then 5.5% yield. The current yield is 4.5 since the stock has appreciated 25%. And with that 5.5% yield, it's safe to say that's a safe dividend. That's also growing. It's growing rather slowly as of late. However, it's got a long history of growing. Over this 19-year period, it's had a compounding growth rate of 7%. I don't foresee it increasing at that rate going forward, not at 7%. In the medium term, at least, you're looking at a 2 to 4% dividend growth rate. I'm judging, of course, by the growing payout ratio and historical earnings growth for this company, which, that rate increase will certainly beat inflation, we hope. Again, I'd argue that this is a safe stock for any portfolio, but unless you're able to get it at the starting yield Ian got, I wouldn't recommend it here with the current dividend yield. I would hold and reinvest dividends in a better place. So for me, the stock looks too expensive at these levels. Ian does say he's averaging up. He feels okay buying it here. I just have to disagree with that. The point of this stock isn't total return. He's had a nice total return in a short period, but it's really about cash flow. I very much doubt that 5 years from now, the stock will be significantly higher. I don't think Ian thinks that either, even though he got a nice total return in a short period. But again, the point of this is cash flow. Look here, I'm cherry picking, but there's endless amount of points on this chart where I can make this point. You're looking at a 10-year period here, 2% earnings growth, which is on the high side for this company. The stock appreciated 22%. The total return was 71%. So the vast majority of the return is the cash flow you're getting in the dividends. You're not getting any real stock appreciation. Now, Ian just got 27% capital appreciation in just a few months. Had someone bought this 10 years ago, their capital appreciation is less than what Ian just got. So Ian really is the exception to the rule here. Again, fast forward 10 years from now, I doubt that his appreciation has changed much since this initial investment, but he bought below the blue line. He got a great starting dividend yield, and that dividend should increase over time. So again, good on him. I just don't get buying it at these prices. There's other places you can move your money. All right, let's move to the next stock. All right, so we have Starbucks, ticker symbol SBUX or SBUX. This is another company that I have, and we're looking at growth again, guys. So this is what it looks like. Great earnings growth during this time period. You see on the chart, 21 years. We have earnings growth rate of 19.22%. When we cut time off the graph, we do see that the growth rate is slowing down. So we're at 16%. You cut more time off and we're at 14%. So it is slowing down. We can see the normalized PE has also slowed down. The stock looks certainly fairer value when you're comparing it to the long-term chart. But when you reflect the slowing of the earnings growth, when you focus more narrowly like this, you can see that the price is actually a little overvalued. Ian got a great entry point here. He's essentially doubled his money when you factor in dividends during this time period. His yield on cost should be about 3%, which should continue to grow quite fast, actually. Well, we have a compounding rate of 24%. So pretty good. The payout ratio is going up. There is a lot of long-term debt on this company, but earnings are still growing fast. I expect the dividend to keep increasing at in the high teens or maybe low 20% going forward for at least a little while. However, your starting yield now, if you purchase shares now, is 1.75%. So even though it's growing fast, you're in a much better situation if you're like Ian, where you're able to purchase these shares below the blue line. So one thing I want to do is illustrate what I look at when I'm buying a stock. There's a good example here. So we're looking at just over a 2.5 year period where the stock price dropped over 23%. Mind you, as it was dropping, the earnings were going up. creating what I like to call a wedge deal. That's where the price is going down while the earnings are going up. What we get here is a PE of 20. 20.7 is right where Ian purchased his shares at. But to put that in better perspective, the stock hasn't been this cheap relative to earnings since 2010, when it traded at $12.78, which is just under a PE of 20, which proved to be a great buying opportunity. Had you bought it then and sold it when Ian bought his, you'd have had an annualized return of 20.2%, or a total return of 315% during this time period. And clearly selling it where Ian purchased shares at was a mistake, because the stock did really well after that. But this just goes to show you, when you buy at a good value, and again, the 20 PE serves to be a good value for the stock, reflective during this chart's history right here. And don't forget those annualized returns of 20+%, or even after factoring in the multi-year period of retraction seen here in the stock price. And just to illustrate further, had you invested in that 20 PE back in 2010, you would have a 25% annualized return through today. So that's what I look for. I think Ian saw what I saw during this period. Again, I think Ian's looking at the same thing here. Earnings are increasing, stock prices falling, we're getting a better price multiple. The stock is cheap relative to itself. He bought in this moment, and we capitalized on this 100% return in a matter of 18 months. Starbucks is a great company. I know Ian loves it. I do think it's at, or more likely slightly above, fair value. Analysts have been actually pretty good at predicting the earnings for this company. I would buy it again. We get another setup like we did back here. What I want to see again is share price falling while earnings continue to grow. In the future, if we get a price below this blue line, then I'll definitely consider increasing my allocation for sure. But for me right now, it's a watch. All right, last but not least, we have Southern Company, ticker symbol SO. This is the other utility company Ian has purchased. Again, similar to the other one, you have a earnings growth of 2.5% over the period you see here. I'm gonna cut time off the chart. We're closer to 3% now. I'm gonna cut a little more time off the chart. Again, 2.5%. So wouldn't expect more than 3% earnings growth in any one year. You get more than that, you're pretty lucky. However, you're getting a decent yield, a predictable company, consistent dividend growth. You got a compounding 19-year growth rate of 5.8%. We really should cut off 2001 here. Let's do that. All right. You've got consistent dividend earnings growth here, 3.6% compounding over this 16-year period. That should stay relatively intact, which would be putting it just above inflation. Ian really nailed these utility companies. Again, massive return. We have a 2-year period here where he, made 70%. Pretty interesting. Historically, this company trades between a 15 to 16 PE. You can see there's periods where it gets expensive relative to itself, and then other times where it's cheaper relative to itself. Again, like the other utility company, PPL Corp, buying below this 15 to 16 PE ratio is really going to do well for your cash flow. Buy this thing now to 22 PE. It's very likely that you're going to lose capital appreciation buying at the current prices, and your cash flow is really going to be stuck at 3.5% to low 4% for a long time. Ian got in when the getting was good. He got in at a PE at 14.39, much below that historical line. That afforded him a yield on cost of above 5.5%, which again isn't growing fast, but it should continue to increase faster than inflation for the foreseeable future. Since the stock is trading absurdly expensive relative to itself, currently at a PE of 22.17, the current dividend yield is just going to be 3.6. And again, it's not that attractive considering the earnings growth and dividend growth for this company. Ian, I believe he doesn't recommend buying this either, not at this level, but I think he's continuing to drip here. For me personally, I would be using the dividends in this company. I'd be reinvesting them elsewhere. It may take a while, it may take years before the stock returns back to its historical PE of around 15 to 16. And I'd like to be a buyer under 16 for sure, but really if you can get this thing under 15 again, like Ian did, unless you can get this stock there, I'd be putting my dividends to work elsewhere. Okay, as teased, let's review my cost basis and allocation in the corresponding stocks. Again, Ian is just showing us a snapshot here in time. His actual cost basis will vary. I'm going to run through real quick comparing my cost basis to his snapshot. It isn't exactly apples to apples, but all these positions, for the most part, were initiated at similar times. So starting with Apple, Ian's tranche, yeah, let's use his rhetoric, is $151.90. Mine is $151.49. So pretty spot on there. I'll save my thoughts for another video, but here you can also see my share count, my cost, my current value. This being my main portfolio, the position here represents a small piece of a larger pie, and this position pays out approximately $67 in dividends a year. AbbVie. Ian's tranche in AbbVie is $69.02, while I have AbbVie split in two portfolios, $66.36. Here in my Robinhood account, you can see I have 32 shares, and it represents an allocation of under 12% here. In my M1 Finance account, I have my AbbVie position in my the dividends portfolio. Here you see the cost basis is $65.50. I have 13 shares representing a 8.9% allocation here. These two positions combined pay out approximately $213 in dividends. Here's Ian's tranche in General Mills is $44.99. My cost basis is $43.34. Here you can see I have 58 shares. This represents a 3.1% allocation in this portfolio. Again, if you're paying attention, the numbers might not make sense here. I have a Robinhood account plus multiple portfolios in my M1 Finance account. So the 3.1% allocation here really represents less than a 1% allocation if we're adding everything together. Okay, I hope that makes sense. This position pays approximately $114 in dividends. Ian's tranche in 3M is $196.44, while my cost basis is $186.37 and $165.82 in these two separate portfolios. I don't doubt Ian's cost basis is probably similar judging by his videos. Here 3M represents a less than 1% position, and here it's a 4.2% position. Expected dividends are a total of $48 for these two positions. Ian's tranche in Altria is $44.72. For me, it's $45.97 here and $47.71 here, representing a 2.9% allocation and a 2.16% allocation in these portfolios respectively. Expected dividend payout is $232. Ian's tranche in Starbucks is $48.14. Here I am much higher at $55.27. Here I just want to point out the failures in trying to time the market. I started this position and the price fell pretty quickly, and frankly I waited too long thinking the price may continue to fall. Ian got in and I, on the other hand, failed to lower my cost basis during the dip, and then I got priced out as the stock price blew past my entry point. This position represents a 2.5% allocation and the expected dividend payout is about $48. Okay, so I am long all these stocks mentioned just now. None of this is investment advice. I'm just an idiot on the internet with a lemonade stand. If any of this seemed like good advice to you, you should definitely do your own due diligence. Ian in his video also goes on to discuss oil, electric vehicles, and Wells Fargo. I actually have a lot to say about that. A lot. Too much for this video, so maybe I can follow up next week. I don't know. Let me know what you think in the comments. Should I do that positive investing video? Should I do the Bruce Wang video? Or if you have other ideas, let me know what you think down in the comments. Peace out. See you guys in the next one.